The feds want this bank to fail. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, First Republic Bank is far closer to failure than we thought, and at a time when the bank needs all the help they can get, the FDIC is threatening to downgrade the bank, which would then limit the bank's ability to access money from the Fed and almost certainly put it in a position to fail. We're going to take a look and see how bad the situation is for First Republic Bank, why policymakers aren't running to the rescue, and more importantly, how Wall Street plans to profit big as deposit flight is likely to continue. And Speaker McCarthy has put a big win under his belt, is now looking to lock horns with President Biden and Senate Democrats over the budget deal. But are both sides running against a clock that they can't beat? Well, wait till we put this in context of the broad economy and the latest data we have, which shows that both parties are running against a limited amount of time as the economy is eroding much faster than we thought. And a follow-up from yesterday's show, our sponsor, Imix Bioscience, at the last minute, right before we published, released better than expected results from their cancer drug. Be sure to check out their stock symbol IMMX on the NASDAQ. The CEO tells us they have more good news coming here in the near future. Let's over to Bloomberg, where we picked today's story up with the headline, First Republic faces potential curb on borrowing from Fed. And what I want you to understand is this is setting a standard of what the government is willing to do, because the FDIC here is going to put limits on what their rescue plans are. And they're kind of doing this deliberately, because if they came out and put out some implied limits to say, look, if a bank gets down to this point, we'll step in. Well, what do you think is going to be the response from the markets and the short sellers? Well, they're going to drive the stock down, and everyone is going to push banks to the point of almost failure and then step in and rescue them right before the government does. And so there's a big reason you're going to see here is why the FDIC, why the Fed, and no other government agency wants to come out and says, here's the line in the sand, because, well, for one reason, they don't actually know what it is. The Federal Deposit Insurance Corp has been giving the bank time to reach a private deal to shore up its finances, but has put no timeline on how long this will go. But as weeks keep passing without a transaction, senior officials are increasingly weighing whether to downgrade their scoring of the firm's condition, including its so-called CAMELS rating, according to people on the inside. That would likely limit the bank's use of the Fed discount window and an emergency facility launched last month. And this is real important because right now, what we've seen is many banks have tapped these emergency credit lines, and if First Republic were to get cut off for this, or other banks could see that they might get a cut off if they reach certain thresholds, then all of a sudden you're looking at a second wave of deposit flight as depositors start to get nervous that there's no government backing behind their money. First Republic has been struggling to find a rescuer for weeks, and any steps to raise capital or sell holdings quickly could be painful for current shareholders because they would take a loss, as we talked about in yesterday's show. The stock lost half its remaining value on Tuesday after a staggering pummeling of its stock, and its quarterly results disappointed investors, and news broke that the firm might sell 50 to 100 billion in assets. And if indeed they get downgraded, they're almost certainly going to have to sell their assets and perhaps take a bigger loss than they want to. We're going to get into exactly kind of what the mechanics of this is in a moment, but let's continue on. As CNBC reported earlier in the day that the bank's advisors have lined up potential buyers for new shares, which didn't help the stock at all. So that would only proceed if larger banks, and here's the key point, which have already contributed $30 billion of deposits to bolster the bank, agree to buy bonds from the company for more than they're worth. The banks would suffer an immediate loss, but would benefit from a rise in First Republic's stock price by averting an even bigger loss on the deposits they made and any FDIC fees that would follow a failure. Now, I don't believe those last parts of this for a moment, that the big banks are worried about an increase in FDIC fees at all. I don't think that's an issue. I think the banks are looking for the answer of how do we maximize our profit on this failing bank? And it's really simple. You start to look at how this plays out. The big banks know that First Republic needs money, and First Republic knows that they need to get money pretty soon or they're going to face a downgrade. Now, they don't know when the downgrade's coming, or if it is, they just know that the FDIC is inside their offices right now and it's putting the heat on management and everyone else. So what happens is short sellers come in and drive the stock price down, hoping to make a profit, which is great news for the big banks because they want to get warrants on the stock for as cheap as possible when they buy all this distressed assets off the bank, of course, not at full price, but at a discount. So the banks then are going to profit on a move higher in the stock when they come in and put up a rescue plan. And the second move is, well, get this. Wait till later on the year and into next year when the Fed is cutting rates. What's going to happen to those assets that the big banks buy? They're going to go up in value. And then you know what they're going to do after that? Well, at the bottom of the next crisis, they're going to dump them onto the public for a fat profit, putting a big win in the big bank's pocket. The Fed considers factors including their capital and supervisory ratings. Firms that don't pass muster can face limits on the frequency or duration of their borrowing, just from the Fed's website, at a time when we could argue that First Republic doesn't need limits. It needs all the help it can get because the situation over there is fairly dire. The California bank said on Monday's earnings report it had $45.1 billion. Now listen to this next part. In unused available borrowing capacity and cash. Now, of course, we don't know. Does that mean $40 billion in cash and $5 billion of borrowing, or does it mean $40 billion of borrowing and $5 billion in cash? So we don't know exactly where they're at, but it could be any further deposit flight puts the bank at a big point of problems. And with their stock crashing, it gives depositors absolutely zero confidence. And I have a hunch that we're going to see a second wave of deposit flight start soon. The lender said that was double the level of uninsured deposits, excluding the $30 billion infusion of deposits from the largest U.S. banks last month. Moreover, executives said withdrawals have slowed in recent weeks, but now we'll just see what happens following, of course, their earnings report and further decline in stock price. But bidders are also learned that they can get a better deal by waiting and perhaps shorting the stock and driving it down until the weakened lender fails to scooping up their businesses and assets at a lower price. Firms that bought SVB and Signature Bank after they toppled last month saw their stocks pop after the deals were announced. So you can almost see this all coming together, that behind the scenes, the banks are going to make a deal to buy the assets, but not put a date on it because they want to get a number on that warrant. And then all of a sudden, at the moment that the bank is at the brink of failure, they all start to swoop in, the stock pops, the banks make money. You see it, how it all plays out. If you want to know why the FDIC and Fed aren't eager to step in, because they don't want to actually go out and put a limit and say, this is where we'll come in and bail people out. They really want the markets to figure this out, because if there is a line in the sand and during the next crisis we see a large number of banks fail, it's going to put pressure on all of these government agencies to step in and bail out the whole industry, and that's something they don't want to do. Let's head over now where we talk about McCarthy, who's got a big win on his debt plan as it passes the House, escalating the standoff with President Biden. And here we can see the vote coming after days of arm twisting puts pressure on President Joe Biden to open talks with Republicans over the debt limit as a payment default looms this summer. Now, we have an update on that here in a moment, but as McCarthy shored up his votes on Wednesday, Biden signaled he remains unwilling to yield to the GOP demand. So as we talked about before, it was no surprise that Speaker McCarthy would have to make some adjustments to his budget to get it passed through the House. We now know that, of course, Senate Democrats are saying this thing is DOA. We're not touching it. We know President Joe Biden has no interest in it at all, but ultimately something here has to happen. And we're going to start to look at this from the standpoint of the economy, because what both sides may not realize, or maybe they're hoping for, is the economy slowing down in a big way. President says he's happy to meet with McCarthy, but not on whether or not the debt limit gets extended. And that's okay, because what you want you to understand here is if indeed the economy is slowing down, it behooves President Biden and Senate Democrats to get the debt ceiling extended now. That is their ultimate objective. The rest of this almost doesn't matter, because that buys them more time to negotiate this out, particularly if the economy slows. You start to look at it on the Republican side, who of course wants to take over the presidency at the next opportunity. They want the economy to slow down, because what have we seen so far, at least how all the politicians are playing it? the president is saying, look at what I did for the economy. And of course, the Republicans on the other side are saying, yeah, but wait till it goes down into the toilet. You start to see how this game is playing out and why both sides are fighting a very rapid ticking clock. Because unexpectedly, we got a last-minute jump in tax receipts that gives a 1-month delay until the debt ceiling crisis hits. What that means, my friends, is we will now see this battle go on somewhere toward the end of July, maybe slightly past it. That's when we're scheduled to run out of money now, as the estimates will come in toward the end of July. So this battle is going to rage on for a little bit longer before we see kind of any results. But now let's start to frame this from the standpoint of the economy, because we've got some new data today which tells us where the economy is headed. And well, the clock for both sides is ticking rapidly. Here we see the U.S. economic growth slows to 1.1%, while inflation accelerates. Inventories dented GDP, tempering the surge in consumer spending, and the Fed's preferred underlying price gauge rose more than forecast. So now let's take a look at some of this data today. But before we do that, I want to mention some people said, hey, how did I know that the market, maybe I should have taken some of my gains off this last rally? Well, there's one report. It's currently $30 a month, going to 40. This shows you how the machines are positioned, looks at a historical overlay, and you can see here they've been selling off. So subscribers already knew, take some of those gains off. You can get a link to this in the description below. 30-day money back guarantee. The 3.7% increase in consumer spending reflected gains in both goods and services, including a surge in purchases of motor vehicles. However, business investment in equipment posted the biggest drop since the start of the pandemic, and inventory subtracted the most from GDP in 2 years, causing the number to come down a little bit more than everyone expected. So what we're seeing now from GDP, which again is a lagged data point, is it's validating what we already know, is that the U.S. economy is decelerating, and in turn, of course, we know the global economy is decelerating. The figures illustrate economic growth that is gradually downshifted under the weight of the Fed interest rate hikes. Well, we could argue that another day. And elevated inflation. I think the issue here isn't either of those, but the fact that wages aren't keeping up with inflation. The rate hike shouldn't matter. If people were getting bigger wages and could afford higher prices, we wouldn't be having this conversation today at all. And while the economy bounded ahead, the start of the year helped in part by unseasonably warm weather. Households and businesses pulled back on spending. Well, obviously, because they had no choice. And that's what happens when prices rise faster than your wages. Well, that means you have less money to spend. We've been saying this was going to happen. Now, let's take a look at the economy and try to figure out where it's going, because this is the battle that both, House Republicans, Senate Republicans, or Senate Democrats, and President Joe Biden are going to face as they kind of duke things out over this budget. Because what we can see, at least in the energy markets, is we can likely expect the U.S. economy to further degrade in the months and quarters to come. And here we have real gross domestic product shown on the left in the blue line, and crude oil prices in red. This is West Texas Intermediate. And the green line, if you're wondering, that just shows us where crude oil prices go negative on a year-over-year rated basis. And what I want you to see is, as crude oil prices are trending higher on a year-over-year rate change, well, the economy expands. And that tends to be kind of how this goes. And when crude oil prices come crashing down, well, the economy tends to follow. And while these aren't perfect, it just gives us an idea that how important energy is into our economy. And here we can see energy, now negative on a year-over-year rate of change, the steep decline, telling us that even as GDP kind of bounces around, that the trend here for the economy is to get worse, not to get better. And sure enough, that's exactly what we're seeing in the oil markets today. As oil steadies after demand fears wipe out gains from the OPEC Plus cut that not too long ago drove oil prices higher, and now they're just around $74 a barrel and continuing to slide as concerns get this over slowing demand overshadowed a largely bullish U.S. stock report, which we talked about yesterday, and the nation's crude inventory shrunk by 5.5 million barrels. But the key part here of all of this, what matters the most, is slowing demand. And this is something both Democrats and Republicans on respective sides are going to have to deal with. You can kind of see exactly how this plays out. If you're on the side of the Democrats, you want this debt ceiling increase to happen now to give you some money to spend to perhaps try to keep the economy from getting worse. That's a game. If you're on the Republican side and you want to take over the presidency, well, you need someone to blame when the economy goes into the toilet. Well, the best way to do that is to hamstring the other side aside from getting some money they need to perhaps push into the economy. And here we can see, of course, the inflation story is the other factor. Is when you start to look at this, you start to balance the fact is, the Biden administration has still been releasing money from the Strategic Petroleum Reserve. And as it balances, what is more important, the economy or inflation? Because higher crude oil prices suggest that the economy is growing, there's demand. At the same time, inflation is causing problems because wages aren't keeping up with it. Well, it's almost a double-edged sword here. And of course, what we know is crude oil prices continue to decline. Not only is the economy coming down, but inflation is coming down, and both of them are bad news in terms of where the economy is headed. And the outlook largely depends on the resiliency of the job market. Well, I'm glad they talked about that in the article too, because we've got that data today as low unemployment and persistent wage gains have so far allowed consumers to weather high inflation and keep spending. Well, the problem is they have no choice but to spend because the things that we need every day are going up in price. What matters is discretionary spending is coming down, and those wage gains, as we've talked about, are just not keeping up with inflation at all. And now the labor market, well, that's the next thing to crack. And we've talked about how this is coming. Well, today's report doesn't give us any optimism that things are getting better. Here we have from the initial weekly claims, 230,000. Now, this was down 16,000, but still we're seeing this remain very close to the critical 250,000 number that I believe that if it breaks to the upside, that we will see an immediate recession. But look at this continuing claims, only down 3,000. So hardly any change there. In total claims broadly, only down 6,000. And here in this chart, what you're seeing is continued claims not budging. This is not a good sign. And what this is telling us versus initial claims is people that are on unemployment are unable to find jobs. But what is kind of roiling the bond market today? Well, that too was in the GDP report. The personal consumption expenditures price index grew at a 4.2 annualized pace in January through March. Excluding food and energy, the index rose 4.9, faster than forecast and the most in a year. But get this, the March data will be released tomorrow, and of course that will give us probably some better indication. Here what we can see is the front end of the curve driving higher. The long end, although pushing up, is starting to get back some of those gains in later trading today. But it just goes to show that the market is worried that inflation is coming. The market really shouldn't worry about that at all, because when you look at the economy, you start to see what the energy market is telling you. You start to see what the unemployment claims data is telling you. It tells us we're headed into a recession. And of course, at some point, both Republicans and Democrats are going to have to get together and come up with a deal, because the economy isn't going to hold together a whole lot longer, and neither is First Republic Bank. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.